Park Aerospace, ticker PKE. They absolutely crushed their Q1 fiscal 2027 print, hitting the very top end of their own guidance. Revenue came in at $18.3 million, which beats the midpoint of their $17.7 to $18.4 million estimate. That's up significantly from $15.4 million year over year.
Right, and EPS hit 17 cents per share, basic and diluted, which is a really solid jump from just 10 cents a year ago. Net earnings landed at $3.53 million.
Wow.
Yeah, that's up nearly 70% from $2.08 million year over year. And adjusted EBITDA, that cleared the absolute top end of their estimate, coming in at $4.57 million.
That is massive. And just a note for you listening, we don't have the live ticker tape reaction to this print in front of us right now, but the underlying fundamentals here, and really the forward guidance, they tell this highly aggressive growth story that retail investors absolutely need to unpack.
Exactly. I mean, today's deep dive is really about cross-referencing their 10Q filing with management's presentation to figure out if this massive multi-year expansion plan they have is stroke of genius or if it's just a huge capital risk.
Right. So let's get right into the profitability, because the gross margin expansion here is what really jumps off the page for me. They went from 30.6% in Q1 last year to 34.8% this quarter.
Which is a huge leap.
It is. When you see a leap like that in manufacturing, you kind of have to ask, is this just standard fixed overhead leverage because they sold more volume, like a factory finally hitting optimal speed? Or did they fundamentally change, what they're actually selling?
Well, it's a combination of both, really. But if you dig into the 10Q data, the product mix is the absolute star of this quarter. I mean, sure, higher sales volume always gives you better leverage on your fixed overhead costs, right?
Yeah, the rent on the factory floor is the exact same, whether you make 1 unit or 10.
Exactly. But that jump to a 34.8% gross margin, that's being heavily driven by a structural shift in what is actually going out the loading dock.
Okay, so we need to talk about Ariane Group then, because that partnership is like the perfect microcosm of this shift. Park has this business partner agreement going back to 2022, where they are the exclusive North American distributor for this proprietary fabric called Air Carb C2B. But looking at the presentation, they noted they sold 0 raw Ariane Group C2B fabric in Q1. Wait, they have exclusive rights to distribute this stuff, but they actively chose not to sell it. Isn't turning away raw material sales just leaving easy money on the table?
It sounds totally counterintuitive, I know, until you look at the margin profile of what they did instead. So in previous quarters, they would sell that raw C2B fabric to defense contractors for, a relatively small markup.
Right, just acting as a middleman.
Exactly, a basic pass-through distribution model. But this quarter, instead of selling the low-margin raw material, Park sold $1.9 million of ablative materials manufactured with that C2B fabric.
Oh, I see. So to put that in everyday terms, it's basically the difference between selling raw coffee beans to a cafe for pennies on the dollar versus roasting and brewing it and selling the $7 artisanal latte yourself.
That is a great way to visualize it.
They stopped being the farmer and became the barista.
Yeah, they took a distributor model and turned it into an advanced manufacturing model. The margins for producing those specialized ablative materials are significantly higher. So that $1.9 million isn't just standard revenue, it's high-octane revenue that forcefully pulls their entire gross margin average up.
Okay, so for those who might not be deep into aerospace engineering, what exactly is an ablative material?
Right, so ablative materials are essentially sacrificial layers. They're designed to intentionally burn away or vaporize.
Wait, they're supposed to burn?
Yes, exactly. They're used to protect the underlying structure of a rocket or a missile from extreme heat during flight or atmospheric reentry. If you're building a solid rocket motor, the heat generated inside that tube is catastrophic.
Right, it would just melt.
Yeah, you need these highly specialized materials to absorb that thermal energy so the missile doesn't literally melt itself from the inside out. It is a critical, absolutely no-fail component.
Well, that totally explains why they have such strong pricing power. Because the 10Q explicitly notes that while they are seeing inflation in raw materials and freight, this favorable mix is largely mitigating those headwinds.
Yeah.
I mean, if your product is keeping a multi-million-dollar Patriot missile from melting in midair, the customer isn't going to haggle over a few percentage points of inflation, right?
Precisely. And this product mix, it ties directly into their broader segment breakdown. We're looking at a revenue mix of 51% commercial aircraft, 43% military, and 6% business aircraft. And their top customers are the heavy hitters driving this demand, AAE Aerospace, GKN Aerospace, Kratos, and Middle River Aerostructure System.
MRAS, yeah. Reading through management's commentary in the presentation regarding that demand, their language is just incredibly aggressive. They repeatedly use the phrase juggernaut.
Yeah, they really lean into that word.
The commercial aircraft juggernaut and the missile systems juggernaut. I kind of have to push back on this rhetoric a bit. Juggernaut implies this unstoppable, overwhelming force. Is this just C-suite bravado to hype the stock? Or do they have actual firm contracts backing up this kind of confidence?
It's a very fair question because, management teams love to throw around buzzwords, and juggernaut is not a term you usually see deployed in dry SEC filings.
Definitely not.
But when you break down the specific catalysts they cited, you actually start to see the foundation for it. Let's look at the commercial side first.
Okay, so the commercial aircraft juggernaut, that's primarily driven by Airbus, specifically the really aggressive ramp-up of the A320neo aircraft family alongside the GE Aerospace jet engine programs.
Right, and this isn't just a general, hope that Park will get some spot orders as Airbus builds more planes over the next decade. They have a firm pricing long-term agreement, a requirements contract with Middle River Aerostructure Systems that runs all the way through 2029.
Okay, so having an LTA through 2029, that provides a massive floor of revenue visibility.
It really does.
But how sticky is that contract, really?
Yeah.
Could Middle River just wake up tomorrow and find a cheaper supplier for these composite materials?
Not easily. In commercial aerospace, once a material is qualified for an aircraft platform, it is incredibly sticky.
Because of the regulations.
Exactly. Park is supplying multiple composite materials, specifically film adhesives and lightning strike protection materials, for the GE90, GEnx, and GE9X engine programs under this agreement.
Right.
These materials aren't just, generic industrial tape. They're engineered into the actual structural specification of the aircraft. So when Airbus ramps up production of the A320neo, Park automatically scales with them because to change the supplier would require a completely new certification process from the FAA.
And that takes years.
Years and millions of dollars.
Wow. Okay. So the commercial side has this massive bureaucratic moat and a contract locked through 2029. That absolutely justifies the confidence there. Let's pivot to the military side then. The missile systems juggernaut. Management used a phrase that really stood out to me. Depletion of the depleted.
Yes, that phrase perfectly captures the stark reality of the current geopolitical environment right now. Global missile stockpiles are just critically low.
Right, with everything going on.
Between ongoing conflicts in Eastern Europe and the Middle East, alongside the broader sort of rearming happening in the Pacific theater, Western militaries are burning through munitions much faster than the defense industrial base can replace them.
Yeah, peacetime procurement rates have basically collided with wartime consumption rates.
Exactly. And Park operates in an indispensable niche within this space. Remember that Ariane Group C2B fabric we were just talking about?
The one they're turning into the high-margin ablative materials for the rocket motors.
Yes. Park is the sole source qualified on the solid rocket motor for the PKE Patriot missile program using specialty ablative materials produced with that exact Ariane Group proprietary fabric.
Let's pause on that phrase for a second. Sole source qualified. That means if Lockheed Martin, or one of their subcontractors, is building a PKE solid rocket motor, they literally have to go through Park Aerospace for those specific materials.
Absolutely. The Department of Defense does not allow defense contractors to just swap in a cheaper alternative from a random supplier to save a few bucks.
Right.
The material has to be rigorously tested and qualified to ensure it performs perfectly under the extreme stress of a missile launch. Park is the only company holding that qualification for this specific use case with the C2B fabric.
That is an incredible position to be in, especially when allied nations across the globe are frantically trying to buy Patriot missiles right now.
It really is.
And looking at their military segment breakdown, missile systems makes up 40% of their total military revenue. And it's not just the Patriot missile either.
No, not at all.
They are supplying components for Raytheon Tomahawk cruise missiles, the Mk-125 warhead used in the SM-2 and SM-6 naval surface-to-air systems, and the Mk-41 vertical launch systems. These are top-tier critical defense programs that governments are actively, desperately trying to restock.
Which is why the term juggernaut actually fits the reality on the ground here.
Right.
The demand isn't speculative. It is mandated by global defense posture and backed by locked-in government appropriations.
Okay, so the demand is absolutely there. The commercial side is locked until 2029, and the global military complex is knocking down their door for these ablative materials. That shifts the focus entirely from demand to supply, I think.
For sure.
How is Park going to physically manufacture all this? Because if you look at their balance sheet in this 10Q, they have built an absolute war chest to solve this bottleneck.
The balance sheet is pristine. I mean, they reported $89.4 million in cash and marketable securities at the end of Q1, and they project that cash pile will hit approximately $114 million by the end of June 2026.
And zero long-term debt. None. That is incredibly rare for a capital-intensive manufacturing company.
Yeah, it really is.
Now, a big chunk of that recent cash injection comes from their $50 million at-the-market, or ATM, stock offering. They sold about 1.8 million shares at an average of $27.58.
Right.
So they diluted the equity slightly, but they are absolutely flush with cash. But here's my primary concern, and it's something I think every investor looking at this stock really needs to weigh. They are about to spend heavily. Looking at this timeline, is the capital expenditure plan too risky? I mean, they have a pristine balance sheet right now, but they're committing almost everything they just raised.
There is always execution risk when a company scales this aggressively, without a doubt. It is a massive multi-year expansion. Let's break down the actual cash outflows to understand what they are physically building here.
Okay.
The centerpiece of this expansion is a brand new major manufacturing plant in Tulsa, Oklahoma.
Right, they just entered a long-term lease for 18 acres at the Tulsa International Airport. The facility is going to be 150,000 square feet, and the total price tag is $65 million.
Yeah, and the capital outlay is heavily front-loaded. They estimate approximately $25 million in cash outflows in fiscal 27, $35 million in fiscal 28, and then the final $5 million in fiscal 29.
Wow.
But the operational return on this $65 million investment is designed to be staggering. It will approximately double their current hot melt prepreg and film adhesive manufacturing capacity, and it triples their solution treating capacity.
Let's actually define those terms to make sure we understand exactly what they're building here. What is hot melt prepreg and solution treating capacity?
Right, so prepreg is a really common term in aerospace composites. It literally stands for pre-impregnated. Basically, you take high-strength structural fibers like carbon fiber or fiberglass, and you infuse them with a specialized resin system. Hot melt and solution treating are simply two different chemical and mechanical methods for applying that resin to the fabric.
Got it.
The end result is a roll of material that is incredibly strong but very lightweight, which aerospace companies then use to build aircraft wing structures or missile bodies. By tripling their solution treating capacity, Park is specifically scaling up the exact manufacturing process needed to support those critical missile system programs.
Okay, so the capacity expansion is scaled directly to meet the twin juggernauts.
Yeah.
But here's the catch that really gives me pause on the execution risk. That facility won't be complete until fiscal 28, and production and shipments to customers won't commence until fiscal 29. We're talking about a 3-year timeline. That is a long time to wait for a return on a $65 million investment, especially when the demand is supposedly knocking down the door right now. Why does it take until 2029 to get this plant online?
It is a long lead time, definitely, but you have to factor in the regulatory environment of aerospace manufacturing.
Yeah.
You don't just pour concrete, plug in a machine, and start shipping rocket parts.
Right, the FAA is going to have something to say about that.
Exactly. The facility itself, the environmental controls, the machinery, and the actual chemical processes all have to undergo rigorous, multi-step certification by the FAA for commercial parts and the Department of Defense for military parts. Every single step must be validated.
Wow.
That creates a bridging period where Park has to maximize their existing legacy footprint while pouring cash into Tulsa.
And it's not just the Tulsa plant eating up this cash. This is where the strategy gets really aggressive, in my opinion. They aren't just funding their own expansion. They are actively fronting cash to secure their supply chain. They are essentially acting like a bank for their supplier, ArianeGroup.
It's a fascinating strategic move. Park advanced 4.58 million euros to fund the construction of additional C2B fabric manufacturing capacity in France on a 50-50 basis with ArianeGroup. The first 2 installments are already paid, and the final installment hits in fiscal 28. In return, half of that new European capacity is expected to be allocated directly to Park.
But it goes even further than France. The presentation notes that at the request of a major defense contractor customer, Park has committed to invest $25 million in ArianeGroup's U.S.-based C2B fabric manufacturing plant.
Yeah.
They are making this massive advance payment in 2026 and 2027, and it will be fully applied against future purchases of C2B fabric by Park.
It's essentially a prepaid expense to guarantee their place at the front of the line.
But those purchases don't even begin until 2030.
No.
Park is taking $25 million of their cash today, handing it to a supplier and locking it up until 2030 just to guarantee they have the raw materials to feed the new Tulsa plant when it finally comes online.
Yeah, but that highlights how severely constrained the global aerospace supply chain is right now. I mean, you could build a $65 million factory in Tulsa, but if you don't have the specialized C2B fabric to run through the machines, the factory is just a very expensive paperweight.
That's a good point.
They are vertically securing their supply chain years in advance. It shows you the immense level of confidence management has in those long-term commercial agreements and their sole source military positions.
Yeah.
You simply do not front $25 million in cash to a supplier unless you have ironclad visibility into the demand on the back end.
So if you're looking at this 10Q, the big takeaway here is really the transition phase. You're watching a company pivot from a highly profitable, steady-state cash cow into a massive, self-funded growth machine. Park Aerospace is a zero-debt company operating in an incredibly high-margin defense and commercial aerospace niche. They're sitting on a massive pile of cash, but they are committing almost all of it to a multi-year expansion to meet demand they describe as a juggernaut.
The strategic alignment makes sense. They have the demand locked in with long-term agreements and sole source defense qualifications. They have the balance sheet to fund the capacity expansion.
Right.
The only question really is the execution over the next 3 to 4 years as these facilities actually come online and navigate that certification process.
Which leads to a really provocative question for you to ponder after this deep dive. Management is incredibly proud of their dividend history. They boast in the presentation about having paid over $30 per share in cash dividends since 2005.
Yeah.
That includes the $2.6 million they paid out in this exact quarter.
It's a legendary streak for a company of this size, and it's honestly a primary reason why many retail investors hold the stock for yield. Management takes that dividend history very personally.
But let's do the math on that. You have $65 million plant build-out in Tulsa over the next 3 years, plus nearly $30 million in advances to ArianeGroup, locking up capital until 2030. Can they realistically sustain that legendary dividend streak if these macroeconomic juggernauts hit a speed bump?
Like a defense budget sequestration, maybe?
Exactly. Or a commercial aerospace supply chain hiccup right before the new plant comes online in 2029. It's just something to keep a very close eye on if you hold this stock for the yield.
Definitely a critical risk factor to monitor. The capital demands of this multi-year expansion leave very little room for error if cash flows from the legacy facilities slow down.
Well, make sure you follow the show for daily earnings coverage to stay ahead of the market. We'll catch you on the next one.